This is your brain on risk. This is Mind Over Money, the podcast where Kevin Cook exposes the psychology of investing.
Welcome back to Mind Over Money. I'm Kevin Cook, your field guide and storyteller for the fascinating arena of behavioral economics. For much of 2020, I was talking frequently about a woman who put the wood to Wall Street with her revolutionary approach to investing, where she only focused on disruptive innovation and concentrated her investment themes around world-changing technology platforms. Of course, I'm talking about Cathie Wood, the founder of the unique ETF firm Qqq Invest. And I say she broke the mold of Wall Street. In my weekly Cook's Kitchen vlog on January 7th, I produced a short video and article about her disruptive achievements and what they meant for the future of investing. That piece is titled, How Cathie Put the Wood to Wall Street. And I cover stocks like Tesla, Square, Roku, CRISPR Therapeutics, and Baidu. That piece describes how I fell in love with Cathie's approach after I heard she had a $7,000 price target on Tesla shares. So I sought feverishly to understand what her seemingly crazy long-term vision was all about for that stock and company. And I was thrilled to find that we already had similar ideas about many long-term investing themes into industries and companies, from the CRISPR clan, including Editas Medicine, to the AI architects, artificial intelligence architects who could harness big data with deep learning, like NVIDIA. But as challenging as 2020 was for most of us adapting to the impacts of the pandemic, I forgot to tell some very important people about my efforts to explain Cathie Wood's philosophy. My family. In my defense, I have to personally email or text a link to something I publish just to put it on the radar of family members, since they don't really pay a lot of attention to my work. I wonder if Kramer has that problem with his family. Anyway, the one person I really started to think about was my Marine son, who just got back from the Middle East in November. I had nudged him well enough when he was working after college to begin saving and investing with employer-sponsored plans. By age 25, he had more savings and larger investment returns than I did when I was 30. And now that he was married in his mid-20s, I wanted to expose him and his smart wife to the philosophy of disruptive investing so they could enhance the potential of their future wealth creation. So I shared a 30-minute Cathie Wood presentation from 2019 that I've found really inspiring, and I've probably watched it a dozen times. But the stock market ramped in December, as you may recall, and we also saw just a fury of fund inflows for Qqq Invest as everybody started to catch on to her sort of magic with thematic investing. So as much as I wanted to put my son and his wife into, say, Qqk or Qqg ETFs as soon as we could, I said we should wait for a pullback, which was a little stupid of me, since one of my major investing beliefs and decision-making metrics is that if you are dealing with long-term money that you won't use for 20 or 30 years, then now is always the right time to begin a position. And in that way, you'll sort of be focused enough to gladly and happily add when there's a correction. Get a little dollar cost averaging in there. So while we waited for the pullback that never came in January, something else happened. No, not the Capitol riot. That something was the GameStop short covering frenzy ignited by Reddit user Deep Effing Value, aka Roaring Kitty on Twitter. And my millennial son was getting very interested in the frenzy too. I was worried he might actually go and buy some GameStop at $300 after he just rolled some funds from an old 401k into a new IRA. Two insights are worth sharing here. One is a dose of reality, and the other is a dose of optimism. First, the hard reality. I knew that lots of young and new traders would get burned following the crowd from Wall Street Bets. That's the Reddit user page. There is never a reliable revolution on Wall Street where the little guy can consistently outgame the big short sellers, and win enough times to make it a plausible strategy. The odds are as stacked against you as taking down Vegas. If you don't understand games of probability in the manner of long-term expected value, you're going to go broke and keep the house rich long before you figure out how to win consistently. My optimistic insight is about Roaring Kitty himself, who made himself a fortune, and maybe some of his followers, in the GameStop blowout of the shorts. A couple of weekends ago, I took the time to watch a few of his old YouTube videos before the frenzy started. I watched one from July 2020, where he explained in detail his bullish thesis on GameStop when it was a $4 stock. And I was really impressed with his deep fundamental analysis as a value investor. And so on Twitter on January 30th, after I watched it, or sometime in late January, I said, make no mistake, the Roaring Kitty did his homework last year on GameStop. The dude was a data-driven, humble, and not certain value investor who had methods and models that exercised probabilistic thinking. Hopefully his followers learn beyond the follow. So that was my my message about, hey, don't just buy GameStop, but learn something about the fundamental analysis that Roaring Kitty did, where he thought the stock could go from 4 to 20, and he never dreamed it would go above 100, let alone 300 or 400. Anyway, it dawned on me, watching all this, after my son went out and bought some AMC, trying to capitalize on that frenzy, that it was time for Dad to lay down the law. Not necessarily with him, but with lots of youngsters with ready cash to burn, thinking that they too could become instant roaring millionaires like the kitty, or thinking they were part of some revolution that was going to overthrow Wall Street. In fact, just last night, I heard a story on NPR about these youngins who actually believe that holding their shares of GameStop at a loss will teach Wall Street a lesson and make the banksters pay for their transgressions in the 2008 financial crisis. I don't even know where to begin unraveling that web of misunderstanding, and so I won't. Instead, I'm going to give you a formula for winning on Wall Street that has nothing to do with fighting the hedge funds and everything to do with being smart, focused, and disciplined so that your savings grow multiples bigger than the average 40 or 50-year-old now possesses. And to accomplish this, I've invited my favorite ETF expert on the cast, Zacks Director of ETF Research, Nina Mishra. Nina runs our portfolio here, Etf Investor, which we'll hopefully get to take a look at. And she also has a great podcast called ETF Spotlight, where she's interviewed dozens of experts across all facets of ETFs and just knows these things inside and out and all the providers. So we're going to have a good discussion, because when I proposed that she come on, I was asking her about there's all these new Qqq ETFs, and I didn't know what they were, and I knew she would know. So I asked her about it, and I'm like, you know what? Let's do a thing where, you come on and give me your top 5 ETF picks for a new investor, and I'll give you mine. Well, she's already done all the work for us. So we're going to have a great discussion about all things ETFs and give you her top 5 recommendations for new investors. Nina, welcome to Mind Over Money.
Thanks for having me on, Kevin. So happy to be here to discuss this very timely and very exciting topic. And thanks for sharing those great insights with us. That was excellent.
Yeah, nothing like a little real world experience to help you learn more. And that's one of my big themes is, like, if you can get a young person to invest in an ETF, they don't have company specific risk, but then they can look at the companies in that ETF and then start to understand and become a better investor.
Yeah, ETFs are great tools for millennial investors because they are low cost. They have a lot of tax efficiency and they are transparent. So instead of buying one company or two companies, you can buy a big basket of 50 or 100 or 500 or even 2,000 or more companies in one ETF, and then hold it in your portfolio for a long time without worrying about high costs or tax consequences, any capital gains taxes or things like that, that mutual funds have that headache. ETFs are more tax efficient, so that is why they are great tools for investors.
Absolutely. I wish I had access to more ETFs when I started. You got into a mutual fund and there were all these restrictions about when you could buy it and how often you could, you couldn't trade in and out of it or anything. So it's just an amazing new world for young investors. So I did want to mention, I left something out of your bio. You have the CFA designation, so Chartered Financial Analyst, and the FRM, which is Financial Risk Manager, I believe, right?
Yes, that's correct.
Okay. So, and again, I want everybody to check out Nina's podcast, ETF Spotlight, which I'm sure you can find on iTunes and Spotify. All right, Nina, you've assembled a core portfolio of 5 ETFs that every young person cannot go wrong with if they start here with these 5. And so we're going to go, I sort of put them in an order that I want to do them in. And we're going to start off with your first is QQQM. And when I say triple, I'll say triple Q a lot because that's the old, that's the Nasdaq 100 ETF, which is, the Nasdaq 100 are the biggest technology and retail companies and some biotech on the U.S. Nasdaq exchange. And so the ETF is triple Q, but there's these new ways to get into the triple Q that I think are really exciting for younger investors. So tell us, what is the triple QM?
So you talked a little bit about QQQ, and I just wanted to add a little bit to that.
Sure.
So QQQ celebrated its 21st birthday last year. It will celebrate 22nd birthday this year, and it is one of the most popular ETFs in the world, with with more than 150 billion in assets, and it is also one of the best performing ETFs of the past decade. It gained more than 500% over the past decade, and it did very well last year too. So most people think that it is a technology ETF, but it is actually a large cap growth ETF. So it holds non-financial stocks which are listed on the Nasdaq, the 100 stocks, top 100 stocks listed on the Nasdaq, which are not financial stocks. So you get all those innovative companies, which are not only included in the technology sector, but in other sectors like consumer discretionary, communication services, healthcare too. Now, in October last year, Invesco expanded the Qqq family. They called it the Qqq Innovation Suite. So talking in particular about QQQM, it is just a lower cost version of QQQ. So QQQ has an expense ratio of 20 basis points, and QQQM has an expense ratio of 15 basis points. So if you're a trader, QQQ makes more sense for you because it is such a large ETF and trades in huge volumes. So because of that liquidity and volume, maybe for a trader, QQQ is better. But if you are a buy and hold investor, then QQQM makes more sense for you. And it basically you own the same stocks, the same basket of stocks at a cheaper price.
Yeah, and it should, in terms of performance results, it should track the original triple Q extremely closely, right?
It will. The difference, it may be just slightly better in terms of performance because it is 5 basis points cheaper.
Right. And you'll hear Nina and I talk a lot about the expense ratios, the cost of owning the ETF. ETFs, they're fantastic vehicles. They're not completely free though, because the fund sponsor or issuer has to, they do have some costs. So they need to charge, a few fractions of a penny to to manage their costs. And you'll find that these ETFs are all so competitive now that the cost should be very low. Like you rarely are going to pay more than 50 basis points for a big ETF. And if you are, it's because maybe they have a special thematic investment platform. And it's the only one out there like it. And so you might pay 75 basis points for it. All right. So
Right.
I think that QQM is a great place to start with as a core holding. And it's for long-term investors, if young people are thinking about their future 20 years from now, you can buy and hold this one for a very long time. And even if you buy the all-time highs this week, which the stock market is hitting all-time highs, even if you buy the all-time high this week, the idea is that you start a little bit now, and then maybe you put in a little every month, and especially during a correction, maybe you buy more, and that's the dollar cost averaging idea. All right, now Nina's second ETF is I'm really excited about. Actually, and I put them in this order just to make things interesting, but it is in her top 5 here, is Xbi, and this is the equal weighted biotech ETF. Tell us about this one, Nina.
So I own this ETF in the Etf Investor Portfolio too, and it has done quite well. I bought it, in fact, last year. I was late at adding this to the portfolio. So this is also one of the best performing ETFs of the past decade. And if you look at IBB, the iShares Biotech ETF, which is slightly more popular than XBI also, I would say, is quite popular. But IBB is concentrated in a few very large biotech companies. This because of its equal weighting, this has a tilt towards mid-cap and small-cap companies. And since you are the biotech expert, you know very well that smaller biotech companies are more innovative, and they are also, if they are doing a lot of innovative work, they become excellent acquisition targets. So the growth potential for smaller and mid-sized biotech companies is immense, and these companies did particularly well last year because so many of them were working on coronavirus testing, treatments, vaccines. So that is why this ETF did pretty well. And as I mentioned, it is one of the top performing ETFs of the past decade. It charges this 35 basis points, which is great for that equal weighting and diversified exposure.
Okay, so even though this is from State Street, you're not surprised by the 35 basis points charge. You think that's reasonable for what they're doing there?
Yes, yeah. For equal weighting, it is. I think that the costs are justified. Most of the equal weighted ETFs from the State Street family charge about 35 basis points. So if you want to buy a plain vanilla broad market ETF, there are ETFs available now for zero fee also. That is by, there's some by BNY Mellon. They launched some zero expense ratio ETFs last year. But when it comes to owning the entire market, there are other ETFs also available at 2, 3, 4 basis points. So I think investors should not worry. Investors should look at the expense ratios, but they should not worry about a few basis points here and there.
Right.
If you are buying a broad, plain vanilla broad market ETF, then probably you can pay 4 or 5 basis points. But if you're buying a more specialized sector ETF, 35, 40 basis points makes total sense. If you're buying a thematic ETF in a very exciting area, probably you can pay 60, 70 basis points too.
Gotcha. And so I just want to recap on the biotech ETF here, the beauty of equal weighting. So people should think about, like, the S&P 500 or the Nasdaq. the big companies dominate the market capitalization of the index and thus of the returns. So it's like, I mean, I don't even know what it is off the top of my head right now, but Apple, Amazon, Facebook, and Google are sometimes over 35% of the triple Q, right?
Yes. Yeah.
Yeah. So there's an example of how the giant companies with the giant market caps will dominate a given fund or ETF, and then those are really where the returns come from. So then with and that's true of the big Nasdaq Biotech ETF IBB. But with the equal weight, the idea is let's own 50 or 100 companies and try and start out owning them at the same weight, and then you get more bang for your buck from the little companies, right?
Correct.
Yeah.
So if you look at the long-term performance of XBI versus IBB, XBI has significantly outperformed IBB. That is because of investing in these innovative companies which have done really well. In fact, if you look at the performance over the last 15 years since inception for XBI, it is up over 1,000%.
Wow. I just pulled up a comparison chart since 2015. Yeah, like late 2014. And I'm seeing the IBB returning, let's say 73, 74% in that 5 years. And the equal weight returning like 180.
Right.
Almost 3 times the performance.
Right. So over the past 15 years, which I'm looking at, IBB has also done very well, but it is up just 540%, whereas XBI is, as I mentioned, up over 1,000%.
I shared my IBB story recently because I just did something here at Zacks. We're going to put out this report of my best trade ever. And I'm talking about the CRISPR stocks because I've done really well with the CRISPR stocks. But I went back to an older story. In 2009, during the heart of the financial crisis, when the stocks were just cratering, I got my first chance to go on television, and they wanted stock picks. I remember this. I went on Fox Business, and I'm like, I actually did not feel comfortable recommending any stocks in early March of 2009 when the market was still cratering. It's like we'd already, the financial powers that be were trying to bail out the banks, and there was TARP and this and that, but stocks didn't care. They were still going down. And I said, I'm not going to recommend a specific stock, but I will recommend the Nasdaq Biotechnology ETF IBB, because that's like the one thing I had conviction about, that you couldn't go wrong buying the future of medical science,
Right.
when it was on sale. And and now there's so many more alternatives. I have one alternative to your XBI that I like, a little ETF I've liked for a while, and that's the ALPS medical, I forget what they call it, medical breakthroughs ETF, SBIO. Are you familiar with that one?
Yeah. So if I remember correctly, it invests in companies which are in phase 2 and phase 3 trial stages.
Right.
So very innovative companies, which are perfect acquisition targets by bigger biotech and pharma companies.
Yeah. And just looking at my my chart here of about the last 6 years of returns, the SBIO pretty much tracks the XBI, which is kind of what you'd expect. So that's just an alternative I wanted to throw out there. All right, let's get to Nina's next ETF. Number 3 is VTI. Tell us what VTI is and why you picked it.
So VTI is kind of a perfect ETF for owning the entire stock market. And it is one of the cheapest ETFs too. This charges just 3 basis points in expense ratio and has over 215 billion in assets. Very, very popular. And it has almost 3,600 holdings. So basically, you get exposure to the entire stock market, large cap, mid cap, small cap, micro cap, everything in the stock market at such a low price. So, and there is another by iShares, which I can throw out. The ticker symbol is ITOT, ITOT. That also has an expense ratio of 3 basis points. That also has billions in assets, just a little bit smaller than VTI. So those two ETFs are great for owning the entire stock market. SPY is very popular, and there are cheaper versions of the S&P 500 ETFs like VOO and IVV, but they own the 500 large cap companies. So if you want just large cap companies in your core portfolio, then you can look at VOO or IVV. But if you want to own the entire stock market, then VTI or ITOT are great.
Okay, yeah. And I see this pick, and by the way, VTI is from Vanguard, which is, just been the champion of low-cost index investing. I see this as sort of the ballast to an ETF portfolio. You buy the stock. That's a great way. Yeah, you buy the stock market and you put it away and you look at it 20 years from now.
Yeah, that's a must own holding for any long-term buy and hold investor.
All right. Next up, your fourth pick is another Qqq fund, and this is QQJ. What is QQJ?
So as I mentioned, in October last year, Invesco had expanded the QQQ family, and in addition to QQQM, they added this one too. So this holds the next 100 non-financial companies that are listed on the Nasdaq, but which are not included in QQQ. So you get all very innovative mid-cap and small-cap companies that are not in your QQQ or QQQM portfolio. And this also has very innovative companies. If I look at the top holdings in this ETF, let me take a look. And this is also the same expense ratio as QQQM, 15 basis points, very cheap. And you get exposure to companies like Okta, Marvell Technologies, Altaion, Trade Desk, Roku, Zscaler, Coupa Software, all those companies, very innovative companies with a lot of growth potential, and all those companies which are benefiting from the digital transformation that we are seeing and which may continue even after this pandemic is over. So I think QQQJ has a lot of potential, and I own this one too in the ETF Investor Portfolio.
I really like this one, yeah. And one name you left off was Crowdstrike. I see the top three holdings are Roku, Crowdstrike, and Trade Desk right now. And so to clarify, so this would be when you think of the Nasdaq index, the Nasdaq index holds, probably a couple thousand companies, and then the Nasdaq 100 is just the 100 biggest. This is the 101 to 200 companies. Is that right?
Yes, that's correct. Yeah. So this also made its debut in October last year, and this has gathered over 900 million in assets already. This has become so popular. So this is a very cheap way of owning those very trendy, very growthy stocks, which may continue to do well even beyond this crisis.
And now, since the Nasdaq 100, I mean, how fluid is the Nasdaq 100? Can any of these companies in the second lower tier, the second 100 stocks from 101 to 200, can they move up into the Nasdaq 100 in any given week?
Right. So that's what Invesco describes as the portfolio, that these companies are not currently included in the Nasdaq 100, but these are eligible for promotion in the future. These have the kind of potential.
Yeah, I see. Right. Yeah. Okay. Very exciting area of growth that, we all invest in. I've owned Crowdstrike. I love the Trade Desk. That's the new algorithmic model of advertising, which I call it the CME of advertising, because advertisers can just buy and sell ad space, programmatically.
Right. Those are such exciting areas. And you mentioned CrowdStrike. There is so much spending going on cybersecurity because, we have seen so much digitization over the past year. The acceleration in digitization has also increased the risk for cyber attacks. And we had a massive hack recently. So obviously the government, not only the US government, the governments all over the world, they will increase spending on cybersecurities. Individuals, companies, they all will increase cybersecurity investing. So that is an area which will see a lot of growth.
Yeah.
So obviously those kind of names make a lot of sense.
All right, before we get to your last pick, number 5, I'm going to just take a glance at the ETF Investor Portfolio that you run here, and just give a shout to some things that you've done really well over the years. I see your top holding right now is a semiconductor ETF that you bought in September of 2016, and that's the SOXX, which is the iShares Semiconductor ETF, and probably tracks the Philadelphia Semiconductor Index, and just today a 270% return since September of 2016. That's some of the things that are possible when you catch these big trends in different sectors, right?
Right. And I added another chip ETF recently, which is the equal weighted chip ETF by State Street. And the ticker symbol is XST there. And that I added just a couple of weeks back. And semiconductors, chips, they are such an exciting area, and you talk about them very often. Now they are used in everything from cars to smartphones to video games and laptops, computers, and there is so much demand for chips, particularly more efficient chips, that we are seeing such a supply problem for chips. And my rationale for including adding another chip ETF was that because we will see a global economic rebound once we have this wider rollout of vaccines later this year. So manufacturing will pick up, global economy will pick up, and because chips are used in everything, so they will benefit from the cyclical rebound. So that is why I added another chip ETF. And I like chip stocks and chip ETFs. All those companies like AMD, NVIDIA, they have done Taiwan Semi, they have done so well. So that is why I own not one, but 2 chip ETFs in the ETF Investor Portfolio now.
Right. And I see another recent addition. In December, you added EDOC, EDOC, which is the Global Telemedic. Global X is the provider. So that would include these what is it? Is Teladoc in there?
Yes, Teladoc is in the portfolio. So that is telemedicine is another trend which accelerated a lot during the crisis because people didn't want to go to physicians' offices for small, routine checkups and all that. But that trend was actually gaining momentum over the past few years. And once people, they become used to telemedicine, then they will continue to do that. They will find it so convenient. So that is why that is a trend, a theme, which I expect that it will continue even beyond the crisis and beyond the health crisis. And ETFs are a great way of investing in themes because you get diversified exposure to a lot of not only US, but global companies, international companies too, which are doing a lot of innovative work in this area. For example, Alibaba Health is included in the portfolio. Now that trades on the Hong Kong exchange, so you will not, for US investors, it is not easy to own that stock. It will be more expensive. If you own the EDOC portfolio, you can not only get to access to companies like Teladoc that you mentioned, but also Alibaba Health and other international companies which are doing very innovative work in this area.
Now, I like that a lot. Now, speaking of international, if I was going to add, I love your 5 picks here, and we're going to get to number 5 here in a minute. If I was going to add any, I might think about an emerging markets ETF. How do you like VWO from Vanguard for that option? Because I like it because it has Tencent, Alibaba, and Taiwan Semiconductor.
Yeah, so emerging markets had underperformed the US markets over the past many years. But in the past few months, there's a lot of interest, a lot of asset flow into these securities and ETFs, because emerging markets, they will also benefit from the global economic rebound. Everyone is expecting that countries like India, China, economic growth will pick up in those countries once vaccine rollout is more wide. So that is why we have seen a lot of interest in emerging market ETFs too. VWO is a great way of investing in emerging market ETFs. It charges an expense ratio of just 10 basis points. Now, it does not include South Korea. That is, investors should remember, because it tracks a FTSE index, which classifies South Korea as a developed market.
I see. Oh, that's a good point.
So the most popular emerging market ETFs by iShares EEM, that would include South Korea too, because that index classifies South Korea as an emerging market. So that is the difference between VWO and EEM. Talking about emerging markets, there's one very innovative ETF which I like. It is called the Freedom 100 Emerging Market ETF. So this, this ranks countries and companies on the basis of their life and liberty freedom scores. Oh. So that is the problem with this ETF is that China is kicked out of the index because of their human rights record. But if you care a lot about human rights and human freedoms, economic freedoms, then that is an ETF worth a look. Now, while China is kicked out, Taiwan becomes the biggest holding in that ETF. So you get a lot of exposure to Taiwan Semi, which has done so well, the past year or so. So the biggest holdings in that ETF is Taiwan Semi and Samsung Electronics. So although both chip companies, Samsung is, of course, so many other areas too, but Taiwan Semi is the biggest chip foundry in the world, the biggest chip producer, and it has become so important in the current environment. So if you want to own a lot of Taiwan Semi and Samsung, probably you can take a look at that ETF.
So what's the symbol for the Freedom ETF?
FRDM.
Okay. We often try and keep politics out of our investing, but if somebody wanted to go that route, there you go. All right. For your final pick in your top 5 here, we have IRBO, which I think is a robotics and artificial intelligence ETF, right?
Yes. So I included that one. I like the theme of robotics and AI a lot. And as you mentioned earlier, that for millennials, they should invest in growth. They should invest in disruption. And this is an area, robotics and AI, which is seeing so much growth and so much disruption, so many new exciting developments and so many new exciting companies as well. And this is also robotics and AI is another trend which has been accelerated by the crisis. Now, IRBO is the cheapest robotics ETF, and I own this one too in the ETF Investor Portfolio. I had another robotics ETF earlier, the one by Robo Global, which was the first robotics ETF, but that is a bit more expensive. So when iShares launched their robotics ETF, I switched to this one, the cheaper version of robotics and AI theme. And I believe
the other one was ROBO, Robo?
Robo, yes.
Yeah.
So I'm sure all millennials like this theme of robotics and artificial intelligence. So they should own one or two thematic ETFs for investing in themes that they believe in. It may be a clean energy ETF or a robotics ETF or a cloud computing ETF or a pod ETF, whatever theme they like. Probably they can, include a little part of their portfolio to that theme. And I think for investing in robotics, this is a great ETF.
One interesting thing you just brought up is how you owned. Now, who is the provider for Robo?
The company is called Robo Global.
Oh, okay. Yeah. So, and you switched from that to the iShares IRBO. That sort of it sort of highlights how great investors have it now with all this competition. You get a small ETF provider who comes up with a new theme, and they're doing well at it, and then iShares says, "Oh yeah, we can do that too." And
yes.
and it's sometimes nice to be with the big company like State Street or Vanguard or iShares, just because that it's going to be well managed. They're not going to have there's not going to be any problems with the ETF, right?
Yes, exactly. I mean, Robo Global is fine as a provider. I don't worry about the closure of that ETF, but
Okay.
the Robo charges 95 basis points.
Oh, right.
And IRBO charges 47 basis points. That was the main reason why I switched. Now, as far as smaller providers and smaller ETFs are concerned, I usually tell investors that whenever a new ETF launches, and particularly by a smaller provider, if they like the theme, they should wait for some time till it gathers some momentum, attracts some assets. And when an ETF gathers more than 50 million in assets, then the closure risk goes much lower. And whereas
Okay.
for bigger providers, bigger providers can afford to run even some ETFs which are very small in size, which are probably loss making for them. But for a small provider, if it's a small provider which has just one or two or three ETFs, if the size is really small, then closure risk remains high. Now, when an ETF closes, then investors do not lose money. Generally,
Okay.
they will get their money back on the date the fund liquidates, the NAV as on that date, but it may lead to some unintended tax consequences. So it is better to avoid, ETFs that may close. Now, talking about Robo, going back to Robo ETF by Robo Global, that has over 2 billion in assets, and that is because it was the first robotics and AI ETF. This launched in 2013, so pretty big ETF.
Yeah, they're gonna be around for a while.
Yes, and they have two, three more very innovative ETFs, robotic themed ETFs too. So
Gotcha.
The company is going to be around. I switched just because of the cost difference.
One last question. We've talked about a lot of different things that involve smaller companies, but if somebody wanted an ETF that just focused on, just on small caps, obviously you could buy the Russell 2000 ETF IWM. How do you like the Schwab SCHA?
I like it. Schwab small cap ETF it's pretty good. So you get exposure to more than 1,700 small cap companies in one ETF. It charges just 4 basis points, and it has over 15 billion in assets. So a great way of investing in small cap stocks. And again, small cap stocks have also done so well over the past few weeks. And in fact, I'm in the ETF Investor Portfolio. I'm trying to have a barbell approach, having some ETFs which provide exposure to very innovative, large cap technology growth companies, and then some exposure to small cap companies. I have about at least 4 small cap ETFs, different flavors, because I think smaller companies will, of course, benefit from the rebound that we are going to see later this year.
Very nice. Yeah, if listeners, we're out of time here. And if you want to learn more about a barbell strategy, definitely tune in to Nina's ETF Spotlight, where you can learn a lot more and you can hear the experts. You can hear the people who live and breathe ETFs, either as managers or analysts, and they just have so much to offer. So, Nina, thanks for joining me on Mind Over Money, and I think we've really done a good service here to help young investors build a core long-term portfolio with ETFs.
Thanks so much for having me. That was such an interesting discussion. I really enjoyed it, and I hope that our listeners will find it useful.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.